Picture this. It's November 10th, 2025. The S&P 500 is trading near a record 5,500 points. NVIDIA's market cap has crossed $3 trillion, and Michael Burry has just vanished. On that day, Cyan Asset Management officially terminated its CC registration. The man who bet $1.3 billion against the U.S. housing market in 2007 and made $700 million for his investors. Is converting his fund into a private family office. He will never have to publicly report his positions again. Why would the world's most famous financial prophet go dark at the exact moment the market is at its peak? To understand what he sees coming, we have to look at who else has walked away. This isn't a retirement. It's a warning. On October 27, 2025, Burry sent a final letter to his investors. He wrote, quote, "My estimation of value in securities is not now and has not been for some time in sync with the markets. That is the polite version." His final public 13F filing from the third quarter of 2025 tells the real story. Burry was holding $912 million in put options against Palantir. He was holding $186 million in put options against NVIDIA. These were not short-term trades. The expiration dates on these puts extend to 2026 and 2027. He is betting over $1.1 billion that the AI bubble is about to violently burst. But he's not just betting on a correction. He's making an accusation. Burry has publicly claimed tech companies are fudging depreciation schedules on their AI infrastructure. This isn't market commentary. It's an accusation of systematic accounting manipulation, and the man who just made that claim has now gone completely dark. But here's where it gets interesting. Burry closing his fund isn't an isolated event. It is a pattern. A legendary investor walking away from a rising market is the single most reliable crash indicator in financial history. It has happened 3 major times before, and every single time, a devastating collapse has followed within 18 months. To understand 2025, we have to go back to 1929. The year is 1929. Jesse Livermore is the greatest trader of his era. He made $3 million shorting the 1907 panic. By September 1929, the Dow Jones had tripled in value since 1924. Everyone was getting rich, but Livermore saw the math. He said stock prices had completely divorced themselves from company earnings. He quietly closed all of his long positions. He started building a massive short position against the market. His associates thought he had lost his mind. On October 24, 1929, the market crashed. By 1932, the Dow had fallen 89%. Livermore walked away with $100 million. That's $1.5 billion in today's money. One man saw the disconnect, the rest paid the price. And then the pattern repeated. Retention point, approximately 2 minutes. Fast forward to March 2000, Julian Robertson was a living legend. His fund, Tiger Management, managed $6 billion. It had generated 31% annual returns for 20 straight years. But he saw the dot-com bubble. He saw companies with no revenue, like Pets.com, trading for billions. In March 2000, he shocked Wall Street. He shut down Tiger Management completely. His letter to investors was brutal. The current technology, internet, and telecom craze bears no resemblance to rational investing. The financial media destroyed him. CNBC called him a dinosaur who couldn't adapt to the new economy. 1 month later, the Nasdaq peaked at 5,048. By October 2002, it had crashed to 1,114, a 78% collapse. $5 trillion in market value evaporated. Robertson was right. He was just 30 days early. In a bubble, being early looks exactly like being wrong. Which brings us back to Michael Burry. His 2025 exit is a direct echo of his 2008 exit. From 2005, he was the only one reading the subprime mortgage documents. He saw AAA-rated bonds packed with B-rated loans. He bought $1.3 billion in credit default swaps. His own investors revolted. They sued him. They called him delusional. In 2007, his fund returned 489.34%. He personally pocketed over $100 million, and then he did the crucial thing. He closed Cyan Capital. He walked away while banks were still pretending everything was fine. 6 months later, Lehman Brothers filed for bankruptcy. The entire global financial system imploded. The man everyone called crazy had been the only one telling the truth. So what is this mechanism? Why does this pattern keep repeating? Markets operate on two forces, fundamentals and momentum. Fundamentals are the math.
What are the earnings? What is the debt? What is the value? Momentum is the psychology. Prices are going up. My neighbor got rich. This time is different. In a healthy market, fundamentals and momentum are linked. In a bubble, momentum completely replaces fundamentals. This is the point where rational value investors can no longer play. Their mathematical analysis becomes useless. They cannot compete with a crowd that does not care about price, so they exit the game entirely. Livermore in 1929, Robertson in 2000, Burry in 2008, the smartest money leaves the table. They know the crash begins when the gap between price and value becomes so extreme that any selling pressure triggers a cascade. The tragedy is, retail investors are always the last to know it. They are the last to buy at the top, and the first to panic sell at the bottom. The pattern is about to repeat itself. So why does Burry believe 2025 is the new 1929, 2000, and 2008? Let's look at the math he saw before he went dark. His $912 million bet against Palantir. Palantir is currently trading at over 300 times earnings. The historical S&P 500 average is 15 to 20 times earnings. This means at its current profit level, it would take 300 years for Palantir to earn back the money you invested. That is not investing. It's speculation. Now look at his $186 million bet against Nvidia. Nvidia's market capitalization has hit $3 trillion. That is larger than the entire stock market of the United Kingdom, or Japan, or France. The Magnificent Seven tech stocks now have a combined market cap over $15 trillion. That is larger than the entire economy of China. 7 companies are supposedly worth more than the annual economic output of 1.4 billion people. Does that sound sustainable to you? Just like in 2007, this bubble was inflated by one thing: easy money from the Federal Reserve. When borrowing costs nothing, investors chase any asset, regardless of value. In 2000, the narrative was the internet. In 2007, the narrative was housing. In 2025, the narrative is AI. The story is always this time is different. Burry is betting $1.1 billion that it is not. But his thesis is even darker than just overvaluation. We have to go back to his claim of fudging depreciation schedules. This is the smoking gun. Here is the translation. Companies are spending billions of dollars on AI servers. This is a cost. Burry claims they are spreading that cost over an unrealistic 10-year period. When the hardware is actually obsolete in 3 years. This artificially inflates their quarterly profits. It makes their earnings look better than they actually are. If he is right, the E in the PE ratio ... is fraudulent. The entire $15 trillion valuation is built on a lie. This is exactly what happened in 2007. Banks claimed their mortgage bonds were AAA safe, but Burry read the documents. He saw they were filled with fraudulent ninja loans. No income, no job, no asset. In 2025, he's not reading mortgage documents. He's reading accounting depreciation schedules, and he has come to the exact same conclusion. The system is fraudulent. Retention point, approximately 8 minutes. So what happens when this bubble bursts? The winners are always the same. Insiders, company executives exercise their stock options and sell at the peak. Venture capital firms cash out their stakes to pension funds, and the smart money, like Burry, moves to safety, cash, gold, treasury bonds, and, of course, put options. The losers are also the same. Retail investors holding AI stocks at their 5,500 peak, pension funds overexposed to tech growth, anyone who believed that this time is different narrative. But here's what should concern you most. Your 401k, your pension, your college savings plan. They are all loaded with these same 7 stocks. Fund managers have to buy them to chase performance. They have no choice. When Burry made $100 million in 2008, it was because millions of Americans lost their homes. He is telling you it's about to happen again. In 1929, Jesse Livermore warned that stocks had become artificial. The crowd ignored him and lost everything. In 2000, Julian Robertson warned that tech had no resemblance to rational investing. Day traders mocked him and were wiped out. In 2008, Michael Burry warned that housing finance had become fraudulent. Homeowners and banks ignored him and lost everything. Today, Michael Burry is closing his fund. He's holding $1.1 billion in puts that extend to 2027. He is walking away from markets he describes as not in sync with reality. The man who called 2008 is calling 2025. He is not abandoning opportunity. He is avoiding disaster. So, which pattern do you trust? The AI will change everything narrative that is driving markets to all-time highs. Or the 100-year pattern of smart money exiting just before the crash. Drop your prediction in the comments below and subscribe because we will revisit Burry's 2026 and 2027 puts to see if he was right. Again.